Let's take a look at a currency carry trade. And what this is it's a strategy that involves buying a high yielding currency and funding it with a low yielding currency without any hedging. That is, borrowing at a low rate and lending it out at a higher rate. And it's going to be profitable as long as the interest rate differential is greater than the appreciation of the funding currency against the investment currency. It turns out that returns can be enhanced through the use of leverage, and because of the near zero interest rates since the mid-1990s, the yen has been the most popular funding currency. So let's take a look at an example here. So suppose the 1-year borrowing rate in dollars is 1.25%. The 1-year lending rate in pounds is 2%. And let's say the spot exchange rate is $2 per pound sterling. A trader who borrows $1 million is going to owe $1,012,500 in 1 year. And if this trader takes the $1 million he's borrowed and exchanges them for pound sterling at the spot rate, he'll receive 500,000 pounds. He can take those 500,000 pounds and invest them for 1 year at 2%, and at the end of the year he'll have 510,000 pounds. And if the spot exchange rate remains $2 per pound sterling, then converting the 510,000 pounds will generate $1,020,000. And the profit will be the $1,020,000 from the money made lending the money minus the amount paid on the loan, which is $1,012,500, yielding a profit of $7,500. But what happens if the dollar appreciates, which means the pound depreciates, to $1.98 per pound? Then those 510,000 pounds will generate $1,009,800, while the profit will be a $2,700 loss. That is, you only have $1,009,800. You'll have a loan of $1,012,500, and so you're going to lose money on this trade. If the dollar depreciated relative to the pound, there would have been a greater profit. So it turns out that as long as the cost of the pound is higher than $1,012,500 divided by 510,000, which is 1.98523, the strategy is going to be profitable. I rounded off here, so you're not going to get exactly the right answer. Let's keep in mind that we have ignored the bid-ask spread. That is, remember, if you're going to do this strategy, the cost of buying pounds is going to be higher than the price received for selling pounds, even if the exchange rates haven't changed. And let's also note that it's also possible to earn a profit borrowing at a higher rate in one country and lending at a lower rate if the exchange rate moves in the correct direction. So in this example, if the dollar depreciates or the pound appreciates. This is a very popular strategy and has been one, especially because the cost of the yen, or cost of borrowing Japanese yen, was so cheap.